the webinar today, we are basing this on a business owner's dilemma, and what we'll be talking about is the various options that a business owner can look at when they're thinking about succession planning. Thank you. Next slide, Rachel. So just to begin with, well, just to give you a bit of an overview of FDS and who we are. We have been established for over 30 years now, and we're an award-winning corporate finance firm. We've got our head office in Wakefield, but we've got other offices in London and Birmingham. We are focused on owner-managed businesses. That's our area of expertise. We've done over 400 transactions in this past 30 years, and you know, our values are highly important to us and they represent who we are, and you can see those listed there. So the main things for us is be supportive, be creative. We're always finding creative ways to get to an end point that's needed. We're always positive, so stay positive. And you know, we keep it real by staying authentic, and we always try and simplify things. So in this corporate world, there can be a lot of legal terminology or terminology that's not known, so we try and make that really, really simple, and we have fun on this journey. So we want to keep it, you know, as fun as possible, but it is a roller coaster and it can be quite a journey when you're looking at succession planning. Thanks, Rach. So in terms of the directors, it's myself. I've been with FDS for over a decade now. My background is that I was a qualified accountant, worked in an accountancy practice, and then moved into corporate finance to specialise in this area. And to be honest, it's a lot more fun than auditing. Auditing is a lot more of a tick box exercise. This, you feel a lot of self-satisfaction in this role, because I'm always striving to get the best for our clients and finding ways of making deals work when things can seem a bit difficult. So I lead on all the transactions of the business, and it's myself and Joe that manage all the projects at that high level. It will be myself and Joe who negotiate on deals and handhold that project right from start to end. With our, you know, supportive team, we would be nowhere without our supportive team. Jo Haig is our founder. She founded the business back in 1989. What can I say? The less I say, you know, there's so much to say about Jo. It's just not enough. But Jo has, you know, she's award winning. She's currently chair for a number of boards. She's won awards for best non-exec of the year. She's also won, you know, a number of accolades there in the corporate finance profession too. But she's written a number of books. She's a very busy lady, but you know, she's absolutely our strength. Thanks, Rach. Next slide. So coming on to the webinar that we're discussing today, it's all about succession planning, and you know, for a business owner, what are the options when you get to a point where you're thinking about succession planning? And there can be a number of reasons why you've come to this stage, or you come into this stage, but the main focus that you need to just really focus upon is that you need to have a plan, whether that's going to be in 5 years, 10 years. It's always looking ahead as much as possible and planning ahead, because we've got to just ensure that whilst we're on this business journey and on this strategy, that are we following and are we aligned with our outcomes that we are wanting to achieve. So in terms of planning, there's a few things that we just want to touch upon that, you know, for owner managed businesses or business owners need to just take into consideration. Now, the first point that I wanted to address here is the ER entrepreneurs relief situation. At the moment, for any business owner, they are able to take advantage of the entrepreneurs relief that's on offer at present, and that is for any consideration or business value up to £1 million, the first £1 million, you are only taxed at 10%. After that first £1 million, you will be taxed in line with capital gains tax. Now, it has been mooted a lot by the current government about making changes to this relief. They have changed in the past 18 months. There used to be a cap of 10 million on entrepreneurs relief. They've brought that down to £1 million. So they have already made a huge change to this relief for business owners. We do think, and it has been mooted, that entrepreneurs relief could be scrapped, and all consideration could be charged in line with capital gains tax. So that's looking at 20%. It's also been mooted that actually any tax payable on future sales may be brought in line with income tax. So this can be a huge consideration for anybody who's thinking about selling, of when to sell, because if you are thinking about selling in the next 12 months or in the next 24 months, you may just want to take into consideration, if the tax rules change, what would that mean? Because the most important factor for anybody who's looking at selling is, what are they going to be left with after everything's been deducted, including tax, advisors fees, etc. So the entrepreneurs relief is a huge point for consideration when thinking about selling your business. I think the other thing that you've just got to note is that trade deals are taking approximately 12 months to complete from instruction. So if somebody is looking at selling their business in 12 months' time, and you want to be parted with that business by 12 months' time, you need to be really talking to advisors now. Why? Because the process that it takes is a timed process, and you know, it's easily 9 to 12 months for a deal to complete. We have done deals a lot quicker, but it's very rare, and I will talk you through the process in the slides to come, but on average 9 to 12 months, that's what you should be looking at when you're looking to instruct anybody. I think the other thing that I wanted to just share with you at this stage is that, you know, when you're looking at selling your business, it's important to be selling your business whilst it's going like this and not flatlining, or definitely not going this way. That's the point where you're going to maximize your value, because there's a good story to tell on this journey, especially if the process takes 12 months. We've got to remember that we've got to continue going like this until a deal is done. So it's always good to look at selling your business when you're on an upwards trend, and that we can keep giving those good news stories throughout that process. And you know, I think the last 18 months to everybody has, you know, can have probably, majority of the cases has been difficult, it's been unusual. So for those kind of deals, we have to just think about, how have we been affected by COVID? What impact did that have on our business? And now we're seeing a bit back to normality. How has that now affected our business coming back? Are we back at those pre-COVID levels, or what has it done to our business? So when we're looking at any transaction, and we're dealing with a number of transactions at the moment, we've been very clear about the COVID impact, because that is another area of negotiations that take place now on the transaction. Is, you know, was it because of COVID? Did it affect you adversely, or in some cases positively? You know, if what's come apparent is that a lot of companies adapted when COVID hit, and they may have changed their direction in terms of what they already do, and adapted it to see if it's possible to actually excel in that kind of situation. A good example I'll give you is that we work with a company who make parts for aeroplanes and things, and they actually in that point in time adapted themselves and started making ventilators. So it just shows that actually, whilst that wasn't the norm, they were able to adapt and actually didn't impact them as bad as they thought it was going to impact them. I think with transactions as well, you've just got to stand your ground in terms of it is a roller coaster and it can be a bumpy ride. So a resilience is a must in deals. And what we do at FDS is really, because we've got that experience of so many transactions, know what hurdles to expect and how to overcome them. And we guide our clients through that journey. And, all I would say is, things take a lot longer than you think, and they never go as smoothly as you may think. But, again, we are well equipped to educate you all on that journey as part of that process. Thanks, Rachel. Next slide. So when it comes to options and what options are appropriate for what business, there's a number of exit options as part of succession planning you can look at, and we've listed a few here. There's the trade sale, so selling your business to somebody else in the trade. There may be some synergies that they can gain from that, or some advantage of acquiring your business. So that is a typical trade sale. Somebody else in your sector that can maximize on that acquisition. A private equity sale. So a private equity sale is selling to venture capitalists, high net worth, and they may have portfolio businesses, but their aim is really to buy your business and to really build upon it and then sell it in a few more years. That's their strategy. They're looking at what return of investment they can get and how quickly. And with private equity sale, there is a certain level of deals that they will look at in terms of value. So they're looking at +5 million majority of the time on deal size. Management or vendor initiated buyouts, so MBOs or VIMBOs. That is another very popular route for a lot of companies, where they pass the business to the management team. They sell their business to the management team, and that can be funded by external funders, or the owner could willingly provide vendor loan notes, so they will be paid over time. And that's what we mean by a vendor initiated buyout. And then lastly, employee ownership trusts. So this has become very popular in the last 12 months. Previous to that, there was only about 500 of employee ownership trust companies set up in the whole of the UK. And whilst it's been around since 2014, and it's the famous John Lewis model, if anybody knows, but this type of ownership is where the departing shareholders will sell their business to an employee ownership trust, which becomes the beneficiaries of that company become the whole of the staff. So you're not just picking a few staff, it is absolutely all of the staff that's involved in that business. So that is another option, and they've become more and more popular because of a number of reasons. And one of the main reasons is that actually for a vendor looking to sell a business, there's actually no tax payable on that transaction. They are able to take those proceeds from that sale tax-free. That is the biggest advantage. All the other options there, you will be paying entrepreneurs relief or capital gains tax, but the employee ownership trust is the only one where you will pay no tax on the proceeds of that sale, as long as you meet the government criteria. So it is a government scheme that's been set up, and a lot of trading businesses, we've done dozen of these now already in the past 12 months. They're becoming very, very popular, but a majority of the business would qualify, but we can check those qualifying criteria with you individually if you needed to look into that a bit further. So I'm just going to talk you through the process of a trade and private equity sale. The process for these kind of transactions are very similar. So when we're looking at a trade or private equity sale, the first thing that we need to do is a valuation of your business. We want to make sure that before we undertake this route, that we have a valuation that we've conducted and that we're all on the same page. Because if your expectations of your business is X and we believe after doing a valuation it's down here, we can really look at why we believe that. And our valuations are very robust and accurate in terms of we will look at data, market data, and we'll look at transactions that have happened in the past 12 months in your sector to give us that indication. But it is an indication, and you're not going to understand the true worth of your business until you do go to market, but it gives an indication. The next thing that we would say is after evaluation, we need to take some tax advice. We're not tax specialists. We obviously deal with transactions on a day-to-day basis, and we do understand the tax implications, but we're not tax specialists. So we would always say go to an expert and ensure that your situation is as accurate as we thought it was. As part of the process, what we do at FDS is we would pull together a target list, a specific target list that is bespoke to your business. So what we do there, we've got full-time researchers that would look at up and down your supply chain, look at your sector, and we will pull a target list together of the possible buyers. Because we use specialist databases to do this, we're able to identify not just the desirability, but the affordability of these possible acquirers. So we can check at their latest accounts, what have they been acquisitive, what's been the data that's been shown. So all our databases that we have and that we specialize in really drill down to that kind of level of detail. And normally our target lists can range from about 50 to 150 targets. We try to have it as bespoke as possible and ensuring that we are making the best criteria for your search as such. As part of that, we will also look at pulling a teaser document together. The teaser document is a no names basis A4 flyer as such. What that teaser document does is just really gives us that opportunity to test if something in your sector is attractive to these targeted buyers. So it's a no names basis. It would give a bit of an overview about your business in terms of what sector it operates in. It'll talk about the development opportunities that's available in your business, and it'd also give a summary of financials of the business, and also it'll talk about the strengths of the business and the reason for the sale. So we've got a number of clients, and it's not just retirement sales, but it's just that actually we've got other interests, or we've taken the business so far and we need a big brother to take it to the next level. So we can give that summary to acquirers. As well as our specific target list, we have got a referrer database of 600 plus contacts. So other high net worth venture capitalists, referrer contacts, accountants, lawyers. So we do send it out to all those referrer contacts as well, and we do get a lot of interest from theirs, because you just don't know who knows who and who's looking for what as such. So that's always been a good lead for us, having those referrer contacts. We would also produce an information memorandum document. So this information memorandum document is the sales document, is the Bible of your business. We talk about the history, how it all came about. We talk about the summary of the financials. We talk about the employees, the structure of the business. But more importantly, we talk about the future possibilities. What can this business provide as opportunities going forward, and how a buyer may be attracted to those opportunities. So we always say in the office that, it's not just the sausage, but it's the sizzle. And we're really good at ensuring that we're able to take that valuable information that we know buyers like to see. So as part of the information memorandum, our quality and standard, we keep it at that high level. We've got in-house graphic designers. We use specialist design software to really present your business in the best light. And first impressions count, and these are the first impressions that they will see of your business. Additionally, as part of our pack that we have to prepare for ready to go to market is a management presentation, because once we've got a possible acquirer engaged in dialogue, the next point is for us to get them into a face-to-face meeting. And that management presentation is for the business owner to deliver. With us there, we'll be helping and guiding, but it's really to share what we've shared in the information memorandum, but really hear it from the business owner themselves, because it'll be you guys who are passionate about your business. It'll be you guys who will be able to express, where you've come and how you've come to where you've come, etc. So it's really just bringing the I am to life as such. The way we work as well is that we'll never put a price on your business when we're going to market. We always invite offers to be placed. So as part of that process, we have a timeline process to ensure that there's a certain amount of time that we'll go out and we'll speak to everybody, but they will all have the same indicative offer deadline date where they've got to place their indicative offers in. And we expect a number of offers to come through, and once we've got those offers, we will work through them one by one. And one important thing I'll mention at this stage is it's not all just about the deal value. It's deal value and the deal structure work hand in hand. So for instance, as an example, if somebody's prepared to give you 10 million on day one and nothing after, and you can leave, you might think that's brilliant. But the other thing might be that somebody else might say, well, I'll give you 20 million, but it's going to be payable over 10 years. And you might think, well, actually, which is the best offer? Do I wait longer to get my 20 million? And is it going to be caveated to some performance or KPIs? Or am I better off just taking my 10 million and making a run for it? So it's just weighing those up, and they are equally important, but we will guide you and help you through that process to understand that a lot better. And what I will say is a lot of deals don't fail on value, they fail on terms. So terms are hugely important. And then once we've negotiated and maximized your value, so the first offer is never the final offer, we will always maximize that position. And then we'll go into an exclusive position with one of the acquirers, keeping the other acquirers warm, and would sign heads of terms. At heads of terms, that's not a legal binding contract. All that means is that we're in an exclusive arrangement for the possible acquirer to do their due diligence and do all their legals that they need to do to completion. So we'd give them a time frame. Usually it's about 3 months for them to do that. And in the meantime, we're always keeping acquirer B, C, 1, just in case anything goes wrong. But one thing that we always do as part of our process is we're very transparent from the get-go. So each of the stages, we are always wanting that clarity and that transparency, and ensuring that our conversations and deal structure is as robust as possible, so we don't have those hurdles later down the line. And then hopefully once all that's done, we're at completion. And that's when we're all ready for a party. But no, it's been this is why it takes 9 to 12 months. There's a lot involved in a transaction, and it's really to maximize that position. I've just had a question pop up from one of the delegates who said, do you happen to know if EOTs are allowable on the Isle of Man? I am not sure about Isle of Man, Stuart. That is something that I could look into and come back to you on. But I will note that question and I will come back to you. I think the tax rules are different in terms of the UK and Isle of Man, but we can look into that and come back to you. Okay, Rach, next slide. So this is an overview of the employee ownership trust process. So just going back to an employee ownership trust, the difference here is that you're going to be selling your business to all your employees as such via a trust. So not each individual employee will own the business. The business is owned by the trust, and the beneficiaries of that trust are the employees. And the employees are only beneficiaries as long as they're employed. So if they choose to leave at any point, they're owed nothing. They can only take benefits from that trust whilst they're employed. So the first thing that we need to do for an EOT process is that we need to just assess your business and ensure that it's right for your business. What are the reasons behind you wanting to sell the business to the staff? So here at FDS, we became an EOT owned company last year. And what that meant for our business is that Jo wanted to ensure that the DNA of the business remained. She wanted to reward all the staff. There's no financial commitment from any of the staff. And what it allowed her to do is to take a fair market value for her business, tax-free. And the way that we've structured it here at FDS is that, you know, we had cash in the business, so we paid Jo a lump sum, and we're paying her over time rather than going for any external funding. But that's worked really nice for us. Us as a team feel really overwhelmed by that generosity, because we've not had to put anything in our own pockets to buy any of the shares, but we've also been able to continue this. And really, this has become our business now, and where we've become business owners as such. The day-to-day operations of the business haven't changed in terms. Jo and I was directors before, we are directors now, and you know, Jo still has control over how money is spent whilst we owe her money. But once, you know, we've already been rewarded via the EOT in a number of ways. We've had you know, distributions made to us as the staff, and we feel that actually it's brought us all a lot together again. So the first thing again for an EOT is doing a business valuation. We have to go through a revenue approval process for this. So the business valuation is quite key. We have to, once we've done a business valuation, and if it's something that you're happy with as sellers, then we can go to the next stage of getting the revenue approval agreed. Once we've got the okay from the revenue, we need to then start having a discussion with senior management of the team. So it might be an MD or other directors of the company, and saying, okay, we've got approval, this is the valuation, we now need to agree a payment plan and structure with yourself in terms of how we're going to structure this deal and what the company can afford, and do we need to go for any third-party funding to fund the transaction. We also need to agree the role for the vendor. So as I expressed, you know, Jo is still a director. She's also a trustee of the trust that we set up as well. So on a day-to-day basis, the roles have remained the same. You know, prior to the sale, Jo used to take high dividends and low salary. We've had to relook at that because now she's not a shareholder. We can't pay any dividends. So we've had to align her salary in line with her market rate and ensure that she's remunerated appropriately. The employee ownership trust is a separate entity. It is a trust company that gets set up. So we have to ensure that that's set up all correctly and all the necessary legal and tax requirements are followed. As part of the trust, you have a trust board, which is separate from your board of directors of the company that's running the business. The trust board needs to include one independent. So for our trust board, there's Joe, who is the vendor, that's a trustee. There's me representing the employees, that's a trustee. And then we've got our lawyer, who's the independent trustee. And it's only, the trust board would only make decisions for the trust. It's not for the company. So it's just making those, it's just another shareholder as such, and it's those decisions that a trust board would make. As part of our process, we would do an internal communication plan that needed to be rolled out to all your internal staff. And we'd also look at an external communication plan if necessary. But this process is a lot quicker. It takes about 3 months to do this from start to finish. And, you know, we've got a very robust team in terms of, we've got a tax team and a legal team, and we deliver that key turn solution. So we can get this done. If somebody's looking at exiting their business and they see this as an attractive way to do it, please come and talk to us, and we can talk through this in detail with you. Finally, the final option is an MBO or a VIMBO process. Now, these have been popular in the past, but one of the important factors that I think, and the more I've got to know EOTs, is that even if you're looking at, you know, passing the business to your main management team, there can be a bit of a hybrid approach where you can do an EOT and alongside it have some EMI options at the side of it. And that works really well, because the problem that I found with MBOs in a lot of transactions is the management just don't have the wherewithal where they can contribute 1 to 2 times salary as part of the transaction. They may need to give personal guarantees, and they don't find that really appealing to put their houses on the line. The EOT just doesn't have any of that. There's no financial risk to any of the employees in that situation. So when you're looking at an MBO, yes, it's possible. Of course it's possible, entirely possible, but there seems to be a lot more commitment required from the management to do that. And what happens with the MBO process is, the first thing we need to do is agree a value. And again, it's about determining, you know, the valuation of the business, and then it's a negotiation. It's a negotiation between the management team and the vendor to agree the consideration and a deal structure that would be suitable for that value. The second step is to agree the shareholding of the management team. So you may choose not to sell all your business to the management team. So it's understanding what percentage are you ready to part with on day one. The third thing that we need to look at is producing a strategic and financial business plan, especially if there's third-party funding that we need to go for. You know, any funders will want a strategic and financial business plan, and we can assist with that financial business plan, pull it together and things. But, you know, that is an important step with an MBO. And we can also facilitate finding funders. So we can help with beauty parading to funders, whether that's debt or equity. We can look at that all at once. We would also, you know, we'd expect, again, a number of offers from a number of funders, and we can negotiate the best terms for that. And then once we've got that point, we need to liaise with tax advisors and lawyers and manage the deal to completion. Thanks, Rachel. So I think I've touched a little bit on valuations already. Valuations are good to give you a good steer, an indication of where the business might be worth. But, you know, valuations and worth are very different, and it is dependent on the person looking into the business what that worth may be. So a trade buyer, that's where you're going to probably have the premium sales, because there's going to be synergistic savings that can be gained upon, and, you know, because of that, you do tend to get higher valuations in that scenario. Where as an EOT, it's got to be a fair market value, because we have to go through that revenue approval process. And when we're looking at valuations, majority of the businesses are SME businesses valued on a normalized EBITDA by the relevant multiple in the sector. Again, like I said earlier, we do robust research into the sectors and try and find comparable deals to ensure that, you know, we're not just picking a number from the air. We do try and make that as robust as possible. And when we're talking about normalized EBITDA, we look at your data to look at any one-off or discretionary spends that may have happened, because if they're not going to happen on a yearly basis, or if they are just a choice, so you may choose that, you know, a golf subscription or traveling first class has been a necessity, but going forward it doesn't need to be, we can normalize those numbers. And it's important that we do that exercise, because every pound could be worth £7 or £8. One of the facts that I just wanted to share with you is that at the moment, the industry data that tracks all SME businesses is showing the multiple as 10.2 times for a 14.3 million average deal. So that's the average multiple that's been achieved over all SME businesses. So they do vary sector to sector, and we do drill down into that information, but that just gives you a bit of an indication. The larger the transaction, the larger the multiple. So on a £14.3 million deal, that's what it's saying is the average is a 10.2 times. For different sectors, there's different models that can be used, and we always look at valuing your business appropriately. So there's other models such as the net asset plus goodwill that really relates to businesses that are heavily invested in fixed assets. So if you've got lots of plant and machinery or buildings and things like that, that would be an appropriate model. And then there's industry specific models such as, insurance brokers and things like that. That wouldn't be a multiple of EBITDA. That would look at what your recurring revenue is and looking at multiples on your revenue rather than EBITDA. And just for anybody who doesn't know what EBITDA is, it's earnings before interest, tax, depreciation and amortization. Rachel, can you go to the next slide, please? So these are just a couple of areas that you should all note that are golden nuggets of value, which actually from a profit and loss and a balance sheet might not be clearly visible. So, what drives value? These are the few things that, we think we highlight and make we call it the hidden assets because they're just not visible on a P&L and balance sheet. But, an engaged management team that doesn't include you. So try and make yourself as not involved in the business as much as you can, because any reliance on you is just going to decrease value. Whereas if we can get the management team as robust as possible and the reliance is on them, that does increase value. If you have any contracts of recurring income, brilliant, that's absolutely brilliant. The longer contracts you have of higher value, that will increase value substantially. Not trying to be reliant on any one particular customer or just a couple of customers. If a loss of one customer can have a huge detriment, buyers will use that against us in any negotiation. So the more spread out that we can be, the less reliant we can be, that would be really good in terms of increasing value. If you're a cash generative business, that's always a bonus, because that just indicates that there's not a lot of working capital required for the business if it can operate without any external funding and alike. Investment in R&D, we need to be always bringing that to the forefront, because you may have heavily invested and it's for future gain, so we need to be clear on any of investment in R&D. Pre-sale due diligence. So what we do right at the beginning of the process is share with you a checklist of all the things that may be needed later, and it's really to get you on that right path to start making sure everything is in order and that it's manageable. Great management information systems. So, you know, in any organization, if you've got great management information systems, that just makes everything a lot more efficient and profitable. And it's just having that. And if there's a trade buyer looking at your business, we've got a situation at the moment, they've got a group of companies, they're acquiring the business of our clients, and they love the management systems that they have in place, and they're using those systems to roll out into their other organizations, because they can already see the results it'll bring. Having a shareholders agreement is really good right at the beginning, because that can save on any disagreements or gives us solutions to deal with any matters if there is a shareholders agreement in place. And profit and add back, so what I was talking about before when I was talking about normalized EBITDA, is just looking through those last 3 years and the latest management accounts and ensuring if there has been any one-off or discretionary spends, we need to have a discussion about them to maximize your EBITDA position. Next, right? So on any type of transaction, these are the key things that we always aim to do, and you know, we should always keep going on. We always say in our organization, delays are disasters, so maintaining deal momentum is key. What we do here at FDS is we keep everyone in control. We try and keep everyone happy. Not always the case, but you know, we're always trying to ensure that that communication between all parties is very clear. Don't ever give up the day job. You know, we always say to our clients, plan for the worst and hope for the best. So keep running your business as you always have been until a deal is done, and a deal's not done until it's done. So until that money comes into your account, don't go spending. And that was the end of the presentation. So I'd welcome any questions, and if you feel free to unmute yourself and ask questions, that's absolutely fine if it makes it easier. I hope you enjoyed it all.
Poonam, could you talk a bit more about the hybrid, the EOT MBO hybrid option?
Of course, we've done a number of transactions where we've used the hybrid approach. So I'll just run through an example which might just pull things together. So our client, he'd set up this business 30 years ago, really, you know, looking for a retirement sale, wanted to reward his staff. What the EOT doesn't do is the EOT, because it's a government funded scheme, it treats all employees equally. And the only 3 things that you can differentiate on is hours worked, the level of remuneration, and the length of service of employees. So when you're making any distributions, you can take all 3 of those things into consideration, or one of those things into consideration, but you couldn't differentiate if, say, somebody was earning 30,000 in sales and somebody was earning 30,000 in admin. You couldn't differentiate between sales and admin. You'd have to only take those criteria into account. So we had a situation like this where he felt, actually, you know, there's senior management that obviously put a lot more effort than our junior staff do, and I feel that they need to be rewarded above those 3 criteria too. And how can we do that? So one of the things you could do is still do an EOT, but you could run the company as you always have, and you can have performance and bonus related payments that the company makes, but it's just to do with the distributions from the EOT. The other thing was he wanted them to feel a lot more worth of it. So he wanted to make them feel that, you know, they're not in that same pot as the other staff. They have got more of a commitment in this business than the others have. And what we did is an EMI scheme alongside it. What that enabled was we got 3 employees who were his senior management team, and we were able to put EMI options in place for them, but all 3 of them to 10% each. And what that means is, because we're doing an EMI scheme, and I'm trying to keep this as simple as possible, but what that means is we issue new shares. So for an EOT to exist, it's always got to have 51% of the shares. So you can't, you only have 49% to play with if you want to do an EMI, because the EOT always has to have 51. Having them have 30% each with an EMI scheme, because it was 10% each, we're able to heavily discount the value of those options because it's a minority interest. So we were able to discount the value of those shares by 75%. So for instance, if 10% was worth 100,000 in real value, they only had to pay £25,000 for 10% of those shares. And again, what you can do with EMIs, you can have them exercised at certain times or at certain key objectives that have been achieved, and they are really flexible how you want to mold them. But that's just one example that we've done. And what that meant is, actually you've got that senior team who are the key drivers of that business, and they're going to maintain it and keep going with it and feel a lot more worth of it. But then they are direct shareholders, so their shares are not owned by the trust, they're owned by them personally. Does that help, Stuart?
Yeah, yes it does, thanks, Poonam.
Any further questions?
Poonam, I just had a quick question, if I may.
Yes, Linda.
I work with organisations that are set up with co-ops. So the EOT option has been a real succession option that we've been looking at in terms of owners wanting to give their business to a worker co-op, for example. The thing that we've been struggling with is the democratic principle of one member, one vote, which exists in co-ops. And I was just interested to hear about that hybrid model that you were talking about, in terms of whether that different criteria could be applied to it. So whether actually, it isn't just about your level of role within the organisation, but whether it could be done using different criteria, because that's the thing we've been struggling with, really, because it's about member ownership, not about employee ownership. So whether actually, there's a different set of criteria, perhaps not calling them members, but those that take a more sort of decision-making role within the co-op than the rest of the employees. So I'm just wondering whether you think that might be something that could work, just not with, just not different levels of employment, but different levels of involvement in the organisation, if that makes sense.
Yeah, I'd love to take this offline if possible, Linda, but I think there's various options that we can explore, and I'd like to just delve into a bit more about what you're trying to achieve and the outcome, and obviously then I will come up with the number of solutions. But EMIs does offer a lot of flexibility of how you want to play this and how it's done. With an EOT, it is only the trust board that will make any decisions. It won't be the whole of the employees, that, and there isn't any kind of proportion that's linked to each employee, if that makes sense. Yeah. So I'd love to take this offline, Linda, if possible. I think, Rach, do we have Linda's contact details? Brilliant. If you don't mind, Linda, we can arrange a call and discuss that further.
Yeah, that would be brilliant. Just to know the options would be really good in increasing my knowledge. Well,
not a problem. Absolutely fine.
Thanks.
Any further questions, anybody? I think we're done. Oh yeah, go on, Chris.
I just wondered if you have any sort of minimum value on a business. I'm just thinking of one particular client at the moment where the business is not worth that much. It's probably only worth about 400,000. Is that much too low for what you would normally be looking at in terms of the involvement of your process?
Yeah, I'd rather be open and honest with you, Chris. We tend to look at businesses with at least a deal value of £1 million, because the process that we undertake is a very detailed process, and I wouldn't want our fees not to be aligned with their expectations. Now, if your client's looking at something like an EOT, because that's a set process and it's a 3-month process, so a lot of our fees are weighted on commitment and contingency fees. Because it's a 3-month process, we can manage that a lot better. So if they're looking at doing an EOT, definitely come and speak to me. But if they're looking more like a trade sale, I can point them to other people that may be able to manage that better than within their fee structures than we would. I'm happy to talk to anybody, but I just like to be real about things.
That's fine.
Thank you, Chris. So if that's the end of the questions, there are contact details. Please feel free to drop me an email, give me a call anytime. I'll be more than happy to take anything offline and have one-to-ones with anybody who feels that would be good. And if there's any follow-up questions, please send them on an email and I'll come back to you as soon as I can. Thank you so much, everybody. I hope you've had an enjoyable afternoon.
Thank you. It's been very